What's up, everyone? All right, so I want to go over this epic short squeeze that we had today on AM. This was pretty impressive. Stock goes up just under 1,000%, and it did it in about 3 hours. So this is obviously a crazy move. We're going to get into the chart. I'm going to walk you through sort of what I saw, how I traded it, and I didn't really fully capitalize on it for a couple different reasons, which we'll talk about. But I also want to talk a little bit about the current sentiment in the market. But why don't we first look at this chart? So we have a stock here that started the day early at like 50 cents a share. All right, so the stock initially pops up right here, as you can see, from 42 cents up to about 50. And this is when it first came to my attention. So for what it's worth, we had a trader in the chat room. He said he just bought 25,000 shares of it at 55 cents a share. All right, so this was the highest volume candle of the day right there. Volume started coming in. It goes from 55 up to 60. It goes up to 70. And you know what he did? He sold his position. You can't blame him. It's a pretty good trade, right? $4,000 or $5,000, 20 cents, 25,000 shares. And obviously, you know, there's no way to know that the stock is going to go that high. Now, we're day traders over here. I certainly am. Most of you probably tuning in are as well. So we're not buy and hold. We're not, you know, the type of traders who just get in and then walk away and, you know, a few hours later come and check our positions. Most of us are using our capital pretty aggressively. So if, you know, you have a $25,000 account, for me, I might be putting the whole $25,000 into a trade and then looking for a 10% return on that trade, you know, $2,500 gain, and I'm out because I'm using that that capital so aggressively. I have to monitor positions really closely because I can't afford to have a trade all of a sudden drop 30-40% on me. My account would be blown up, right? That would not be acceptable. And so my approach for day trading is that, generally speaking, I only take one trade at a time and I'm focused intensely on that trade. And so when I see something up here like, you know, a clear pullback pattern, this big red candle or this extension candle going up, this big green candle with a topping tail, I'm taking profit into it. Now, this is what we're doing as day traders. We're leveraging large amounts of capital to profit on relatively small moves in a stock. So a 10-cent move, which, you know, for an investor is nothing, for us could be our daily goal. Boom, just like that. All right, so the trader that took this morning in the chat room, he's got his $500,000 badge, so he's a verified profitable trader. Really nice trade on this, but he takes his profit. So then it ends up going and breaking out right here. And, you know, some traders, I'm sure, took that trade over 78 cents. However, I saw that and I was like, I don't know, guys. It's a little cheap. You've got a couple topping tails there at 78 cents. I'm not sure that we're going to see that follow through. Well, you know, I was wrong. And it goes up to 87 cents. It squeezes, as you can see here in that one candle, up to 93 cents. Then we get a little pullback under $1. Comes up to $1, and it actually pierces the level and goes up to $1.02 before dipping back down. Typically, that's a short. You see the break above and then back below, short with a stop at the high. Profit taking for longs right around that level. Okay, then I see it come back up, and my entry, $1.07. My entry was actually, as soon as it retested $1, I got in right here. So that was my entry. That was my first entry right there, which, as it turns out, was a terrific entry because it ended up going up like a solid 300% from there. But naturally, I took my profit fairly early on as well. So I got in and I started taking profit on this, I don't know, somewhere around $1.20. And then I got back in on this pullback right in this area and took profit again at about $1.22. So these are small trades. So I'm back in around here, taking profit back here at $1.22. All right. And then coming into the open, this is where I got the next trade. So I got long here for the break of the pre-market high, which is 124. And we squeezed up to 133. Fantastic. And then we dropped down. We sold off hard. And I was like, all right. I took my profit, by the way. So I got in, again, another trader who's not a day trader Might still be holding from who knows where, but I get in, I take my profit up here. It then pulls back, and this candle, now I didn't see that coming. That right there, that was kind of a big deal. All of a sudden in that candle, we got that squeeze up, and it halted right at 134, which was the previous high. So I wasn't in that trade. I really didn't see that coming. But I did understand that a lot of people were talking about this as being a short position. The stock was already up 190% when it was hitting, $1. So there were people that were shorting off of that break of the pre-market high, adding, and then you got that top of 135, and now they're just looking for it to break down below $1 for that all-day fade. So this gets in a little conversation about market sentiment. So as you know, I'm sure, you understand that there's long bias traders and then there's short bias traders. And then there's also a group of traders who comfortably switch from long and short and they go back and forth. In the last month or so, we've seen a lot of the short bias traders doing quite well. Essentially, and there's different techniques for how to short stocks, just like there's different techniques for how to buy stocks to the long side. But one technique that a lot of short sellers will use is as stocks are going up, they're shorting it. So if a stock, for instance, goes up to $1.20, they're shorting it $1.20. And immediately, because they're shorting as the stock is squeezing up, they're expecting to go red on the trade. So they start with, let's say, 1,000 shares. And then it goes up to $1.25 and they add another 1,000. Goes up to $1.28, they add another 1,000. And so when you look at the way these short sellers trade, they're adding as the stock is going higher. So they're going, basically their P&L from when they enter is going more and more red until they get the confirmation of the reversal. Now you might say, well, why don't they just wait for the confirmation of the reversal? And the answer is because by the time you get that confirmation, you're already well off the high and you've missed a good entry. And so scaling in does make sense. The inverse to this would be to the long side where a stock is selling off. Maybe it's dropped 20, 30, 40%. It's a bottom bounce reversal. You've got like 10 consecutive red candles and you start buying it. And usually I look at, half dollars and whole dollars as areas to start adding. And I'm looking for that spring off the low. So these are both inversion strategies where you're trading for a reversal back to some equilibrium, which is usually like the volume weighted average price. Although for some traders, it's just a quick reversal back to like the 9 or 20 moving average before the next move higher. So like on a weak stock, you could be buying for the bounce off the low and the stock ends up just bear flagging and then going lower. And that can still be a profitable trade. Just like a short seller potentially shorting something that's going higher. And then as it pulls back, forming a bull flag, they're taking profit and they're green as long as they added enough going higher. So this is a strategy where certainly there's a lot of people out there that trade it, both buying weak stocks and shorting strong stocks. So it's a reversal strategy, but it requires quite a bit of conviction because you're almost definitely going to start the trade and go into the red. All right. Now, here's the problem with that strategy. And listen, I'm not trying to call any strategy out because my strategy is not perfect. There's no such thing as a perfect strategy. Every strategy is going to have certain degrees of loss where you're going to have trades that, go against you. And so in the case of AM on this one, my strategy didn't call for just buying it right here. It squeezes up. And so what ended up happening is I think that there were some short sellers that ended up getting stuck. So it now is halted up. All right. So we've got a halt up and it opens and halts up a second time. All right. And I did a dip and rip in this area, halts up at 55. Then it opens higher, squeezes up to $1.75, and then halts down at $1.51. So again, this is an example where some traders who would maybe be really quick would have sold short, add more short, add more short, add more short, add more short. And then as it drops right here, potentially, they could be covering for profit. Right? Covering back down here at like $1.52. And again, that depends. If you start with 10,000 and then add 1,000, 1,000, 1,000, your cost basis will be low. If you start small with 1,000 and then add 1,000, 1,000, 1,000, 3,000, and 4,000, your cost basis will be higher and this would be profitable. So then we come back up. All right, so now I take this trade here for the long over 170, and we squeeze up into a halt at 172. And then all of a sudden, on resumption, it resumes and goes into another halt at 197. And now the traders who short this leg up, shorting as it's going higher, who didn't cover, now they're getting squeezed as it's making new highs right here. So this is where we're getting a real short squeeze in this area. Okay, so in this candle here, you have buying that's coming in two forms. Long traders who are chasing the momentum and expecting that we're going to get a continued squeeze, and short sellers who are covering for a loss. Now you have a big imbalance to the buy side. It resumes and goes up to 210, halts again. It resumes and goes up to 250. Holy smokes. So now this is where, and you know, for what it's worth, if you short 10,000 shares of this at $1.25, that's a $12,500 position. All right, so if you had a $12,500 account, you took that whole thing short. Well, the problem is to buy back those 10,000 shares at 250 is going to cost you $25,000. Right? So all of a sudden, immediately, you're getting potentially broker liquidation, because when you short a stock, you have the potential for an infinite loss. That's in theory, because of, you know, what happens when you have a stock, you know, just for reference, like an HKD on the daily, and I'll just show you that's daily, that ends up going to $2,500 a share, $2,500 a share, just like that. If you shorted 10,000 shares at, you know, $20, as soon as it went to 200, all of a sudden you're down $2 million, right? Or, well, let's see, 20,000 to 200, right? And then, I mean, it's just, you could lose an incredible amount of money, but in theory. Now, obviously, you can set stops, but one of the challenges on these low price stocks, and this is specific to low price stocks. So here's a challenge. On these low price stocks, when they're trading at 80 cents, 90 cents, $1, there's so much liquidity. You could buy 50,000, 100,000, 250,000, 300,000, 400,000, 500,000 shares. You could take huge positions. This right now today has total volume of 64 million shares. So you could easily trade hundreds of thousands of shares. And if you're shorting as something's going up, you could just keep adding 10,000 shares on the ass, 10,000, 10,000, 10,000, 10,000. And next thing you know, you're in a 150,000 share short position. Now, once it starts to get more expensive, notice that the volume is declining. So let's just look for here just for a second. Let's look just at the volume. All right, so what you see is as it's going higher, the volume is decreasing. And this is very common. You have peaking volume on a couple of red candles, but the highest candle of the day has relatively light volume. So now, for what it's worth, buying back 150,000 shares of this stock when it's at $2.50 is a lot more difficult than buying 150,000 shares at 87 cents once they're over $1. So you end up having, in this case, this squeeze up to 250. And now what I think ends up happening is you're getting some brokers liquidating positions. They have a client who has a short position that is negative, it's in the red, and exceeds the equity that that person has in their account. And now the broker's like, whatever this person ends up losing, we're going to technically be on the hook for until we can maybe get it back from that person. So that's when the broker just starts sending out the buy orders to cover it. And the problem with these low price stocks is they halt so quickly and then they gap higher. So there's not enough liquidity to move in and out. So seriously here, it ends up halting up on this candle on 1.5 million shares. It halts up on this candle on another 1.6 million shares. It halts up on this candle on 800,000 shares. So you could see how it wouldn't take too many really big short sellers squeezing this stock higher because of the number of shares for them to buy to cover. So it ends up halting down right here. It hits a high of 197, which is crazy. And then it halts down right here. It drops, it sells off. It hits a low of like 150 and immediately halts back up. Halts back up at 170 at 275 and is showing a resumption of $3. So now in between the halt, this is where you really got the epic squeeze. And look at the volume on this. The volume is so light. So it halts up here, 800,000 shares. It halts up again on 500. It halts up again on 400. And then here, it's opening this much higher on 700,000 shares of volume. So you're seeing declining volume as you're getting that rapid expansion. And this is really a short squeeze. And, I don't know if there are any traders out there that ended up losing 6 or even 7 figures on this stock. It's easily possible. I just, I don't know. But this was an incredible move. So, and on the long side, for me, unfortunately, aside from a couple of trades, this pullback right in this area, this happened, it halts down, then it opens and halts up immediately. There was no time to take a trade. Several of these halts here were so instantaneous, there was no time to take a trade. How and why would it halt without that hesitation? And that to me is someone basically just doing a market buy order. That could be a broker liquidating a position. So you may have had someone that ended up accumulating a really large short position on the move from maybe 75 cents to $1. And between $1 and $1.25, we had a lot of volume on this one. Let's see, let me just switch this chart here for a second. So on this chart here, you can see the intraday volume profile. So right here, pre-market. So this just shows you the volume, basically at the prices it occurred at. So you had peaking volume right in between this area of $1.15 and $1.23, which is where I was trading at pre-market, and that was the area where it was super thick. I was buying 20,000 shares in and out with no slippage. You could have easily bought 200,000 shares. It would have been no problem. This thing was so liquid, tons of volume, right? But then you get into these areas where there's not a lot of liquidity, and all of a sudden it moves fast from 120 up to 150. And then it hits this high here. Then you have another period of pretty high volume, and then it rips up again on light volume. There's no liquidity. Then you get this area here that's got more volume, but that is from the price action that occurred right here, not from the price action that occurred before it. So that was from, and I don't think this updates based on what, you can change these settings, but let's see, just if I change it by visible bars. So if I go back here, this is basically what it was. We had a ton of liquidity right in here. And then once we broke out of that, it just moved real fast. So now there wasn't the liquidity to get in and out of the position. And this has been a real problem in this market for the last 6 weeks, is that we haven't had a lot of liquidity. So it has been harder to accumulate big positions, and we've seen these really big drops. So in any case, this one ended up being a parabolic short squeeze. And on this move up here, no doubt there were some shorts that got buried on it. And are there some longs that bought the very top up here thinking it was going to keep going? Well, I don't know how much of this volume was to the buy side, but presumably that's possible, although it could have still been buy orders that were covering short positions. So I don't know. But in any case, right now, you're in this consolidation between 305 on the high side and 249 on the low side. One of the things that I'll say, again, I'm just sort of looking at this as an example of a pretty powerful short squeeze. And when you think about the mechanics of a short squeeze and how it happens, it's fueled by a massive imbalance to the buy side with very limited numbers of people out there selling the stock. And when you have that supply-demand imbalance, you get these huge moves. And so, the market makers on this, they're stepping back. They're not sitting here with a big order to sell it, because if they do that, they're going to go short the position. They see that huge imbalance to the buy side. They're stepping back. So the market makers are not doing a good job making the market, so to speak, on the stock. It thins out, and all of a sudden you get these really quick moves. And the problem for the traders that get stubborn, the higher it goes, the better it looks for a short. And you know what? Eventually, you're right. So is there a short seller out there today who started a short position down here and kept adding and 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 adding? I am sure somewhere there is. And is that person green right now? They might be. If they added enough up here, they could be. However, the short strategy that has an absence of stops is a strategy that will eventually result in a blow up. Every strategy needs to have risk allocation where you say, this is what I'm willing to risk. And if I get stopped out, that's it. And so there are some strategies that have really, really high accuracy and lots of small winners. But then when those losers come, they're big. And, look, if you're making money and that's your strategy, you just allocate that every 6 weeks or whatever it is. I'm going to end up, having, 15, 20, 30 green days and then a really big red day. And that's just the way my strategy is. And then I'll have another 15, 20, 30 green days and then another big red day. And as much as you want to avoid those red days, they'll just still happen from time to time because that's part of the dynamics of your strategy. My strategy is a little different in that I really need volatility. And so if I have this extended period where things are really choppy, I'm not having big red days, but I'm also not having big green days. And so I'm just kind of going sideways. I don't really like that too much either. In some ways, it's more exciting to at least be making really good progress. And then, okay, you give back half of it, but at least you're making really good progress. For me, going sideways gets a little bit, you start getting burnt out just going sideways. But as a momentum trader, for me, if I'm not seeing really clean action and I've got a lack of conviction, I have to reduce my size. If I reduce my size, my winners are going to be smaller. So for me, my accuracy, because I'm buying stocks that are high, ends up being lower. And because I keep pretty tight stops, that brings my accuracy down as well. Someone could have, in theory, 100% accuracy if they're super stubborn and never cut losers, right? If you never cut your losers, then you will not have losers, I suppose, until you end up with one stock that gets so far out of control that it could end you, which, you look at the HKD type of stock and, that's the possible downside. So, I think regardless of the strategy you trade, if you're a short seller and you're doing short scalps and you're adding higher, you just know that part of that strategy comes with it, that add higher works until you have the one that just keeps going. And you can't keep adding because you ran out of buying power, you ran out of shares to borrow, and you're out, and that's it. And so that's a downside of that strategy, right? If you're a momentum trader, a downside of the momentum strategy is that if you're seeing dispersed attention across the market where one stock is strong and then it kind of fades, and then another is strong and kind of fades, you're not seeing enough conviction in any one stock. They are having multiple legs higher. And so today, for instance, on PHSV, this is one of the ones that I traded today, and I did okay on it. PHVS, sorry. So on this one today, this is very choppy, right? This was not clean. I had a little trade on it pre-market in this area. That was okay. It came back up here. But, this is not sustained momentum. It did not hold up. However, if you look at it yesterday, it actually was pretty clean. So this is the type of stock that I'm going to typically be able to do better on when you've got these longer periods of momentum. But listen, this is a stock that went up 100% in one day. That's bull market stuff. In a bear market, you don't see a lot of that. In a bear market, you might see 10, 15, 20%, just enough to short, and then cover on the way down. So I think that the shorting tops definitely is a strong strategy in a bear market when you're not seeing conviction, you're not seeing individual stocks making big moves. But the inherent risk with it and challenge is that you never know when one's going to do something like this and go up 50 or 100%, or like AM and go up 1,000%. And unfortunately, especially when it coincides with these low liquidity traps and these halts and these gaps higher, you run into a position where it can be really hard to manage risk on it. And so, like anyone, you start to learn within your strategy, what are the types of stocks that risk is going to be higher on, that I therefore have to be more cautious on? And what are the stocks where I can have a little bit more conviction that we're not probably going to see something like this? But it can be hard to know. It can be really hard to know. So this was a 38 million share float. The float was a little higher. Typically, those higher floats, don't end up giving us, this kind of move. So I didn't see this coming at all. but I traded it a little bit on the way up, and hopefully you guys got a piece of it, whether it was long or short. Hopefully you came out with some profit. But if you came out on the wrong side of it, definitely look back at your trades and ask yourself what you could do to try to tighten them up and either get better entries or cut the losses a little bit faster. So I hope this has been interesting. I wasn't planning on doing any episode today, but this was just such a wild move. I thought I might as well record it, upload it, and you guys can watch this for months and years to come. So hope you find it helpful, and I'll see you back here Monday morning for the morning show. Tuning in. I hope you tune in right around 9 a.m. I'll be live streaming. All right, I'll see you then. A reminder as always, trading is risky. My results aren't typical, and there's no guarantee you'll find success. Whether you trade on your own, you'll learn from me. So take it slow. Hey, I want to thank you for watching this episode. I hope you really enjoyed it. This channel has crossed over 1 million subscribers, and it's thanks to viewers like you. If you want to check out a couple other episodes that other traders are watching, you can see them listed right here. Thank you as always for tuning in, and I hope you subscribe to the channel.